There are three massive mistakes that people are making with their trades. 90% of traders lose money long term, and most people think it's to do with risk management. But it turns out it's nothing to do with that, because the reason traders lose money is actually due to not trading a mechanical rule-based system. If you want to become funded and consistently profitable, then this video is for you. Let's jump straight in. Okay, so this is what you're going to see within the market. So what the institutions do is they need to engineer liquidity. So what you'll see will happen is price will simply just consolidate. So this is between potentially an Asian session high and an Asian session low. So they're going to move price from a range high to a range low, back up to a range high. And what this is simply doing is just engineering liquidity. And we understand that there is buy-side liquidity resting above these significant highs right here. And we understand that there's sell-side liquidity resting below these significant lows right here. And as you can see, this could be the Asian session high, or this could be the Asian session low. This could also be the London session high or the London session low. It doesn't really matter, but the point is that you understand that there's liquidity resting below these session lows and there's liquidity resting above the session highs. And this is in the form of buy stops, and this is also in the form of sell stops, and then also stop losses. So we have stop losses resting above these highs and also stop losses resting below these lows right here. And what we're simply looking for is during a kill zone. So for example, let's just say this line right here represents the London session kill zone. What we're looking for is a sweep of sell side liquidity. So price could come down and then run that sell side liquidity like so. This could be during the London session or New York session. And then what we're looking for is a run of liquidity to the upside. So once we see this move right here, this is manipulating traders, okay? This is enticing traders, thinking that this market is going to go short, when in reality, what this is actually doing is just trapping traders, thinking that it's a breakout, and they are completely on the wrong side of the market. So this is just running the liquidity below. This is just manipulation for the expansion phase to the upside. And it's our job as a trader to identify, okay, this is our range. Identify this is our manipulation of that range, and then we can look at taking part in the distribution phase, which will be institutions moving price to the upside like so. So this is the model that we need to be using when we are executing within the markets. If you want to become profitable, then listen up. Most people think that you need to have one huge winning trade in order to make it in trading. But I can assure you this is definitely the wrong approach. What you need to do is have a trading strategy that you can take repeatable, small, bite-sized pieces out of the market. This could be done by using a fixed risk to reward. So for example, a 1 to 2 or a 1 to 3. That is how you become consistent and profitable. This right here is USD CHF on the 15-minute time frame. The first thing that we need to understand is our directional bias. So for example, what you can see is we have the 50, the 100, and the 200 exponential moving average, and they are all in order. So you can see here the 50 is greater than the 100, which is greater than the 200. This indicates to us as a trader that we are long bias on this market. So if you just zoom out like so, you can clearly see the momentum on this market is to the upside, right? Because, you know, just in terms of price is moving from bottom left to top right. And don't get me wrong, this is not a trend line. This is not something that I'm looking at using, but it's just to show you that momentum is clearly sloping to the upside. So we understand that we are long bias on this market. And what are we looking for? So we're looking for a sweep of sell side liquidity. And you're probably going to ask, how do we understand where sell side liquidity is? And it's very, very simple. We have liquidity resting below the session based lows. So for example, right here, we have liquidity resting below the Asian session low. So what we're looking for is we're looking for price to come down, manipulate below the Asian session low, and then we can look for a potential long trade to the upside to go with the momentum, which is longs on this market. Why do we want to see this manipulation right here? It's very simple. So what this will do right here, this will induce traders into the market thinking that this is a breakout right here. But we know that momentum is to the upside. So more than likely, this is just grabbing liquidity and grabbing orders before the market then makes its move to the upside. Because what this will do, this will induce traders thinking that we're breaking out. And what this will also do is stop out any traders who are long in this market. Let's say they get long right here. Their stop losses are going to be below this significant session-based low right here. So what this is doing, this move here is providing the fuel, providing the liquidity to move the market in the intended direction. So what you can see here is the institutions start pushing price to the downside. And what this is doing, this has just manipulated the traders out of the market because they're going to be getting stopped out. But also you can see we closed below. So breakout traders will be looking at getting short on this market. So that provides the liquidity. We can enter on the break of that bullish candle high. It's very, very important that you wait for confirmation. We need to wait for a bullish candle close because this will indicate to us that bearish momentum is stepping into the market. And so this is depleting sellers out of the market and buyers are showing that they are back in control. You can see we're triggered right here on the break of that candle high, the bullish candle high. And then we're looking for a simple 1 to 2 or a 1 to 3. It's really up to yourself, but we're triggered long right here. And you can see during the pre-New York session, this trade smashes take profit right here for a 1 to 3 risk to reward. And as you can see, and as I've just explained this case study of a trade, everything here is fully mechanical. Everything is defined and everything is rule based. Every single confluence has to take place in order for us to execute a trade. And you can see when they do line up like so, okay, that's when we execute, and that's when we get a very, very high probability setup. It's very important that we wait for these confluences and we don't just blindly start entering trades.